Well, the sensex and the nifty posted cuts of 1% each. It was the biggest weekly fall that we saw in the last 3 months. The Nifty Bank, in fact, recorded its biggest weekly fall in a year. So things have been quite tricky this week all over the place. Hello and welcome to Editors Roundtable. I'm Sonia and today we have a full house, all the editors in the house today. It's a pleasant surprise and a good one at that, but it's been a really tricky time for the market, right?
I think I've been the culprit, Sonia, in terms of this not being the full house. But glad to be back with all of you. And yes, absolutely. I mean, I think very tough week. Yeah. And in a week, actually, given the way HDFC Bank fell, and given the way it saw the kind of delivery-based selling, in 2 days, it was quite eerie. I mean, 2 days, 16,000 crores of selling and a stock like HDFC Bank. And the second day when I came and I saw the HDFC Bank ADR second day down 9%, I was quite scared. But in that sense, the market's not been that bad actually. Even if X of HDFC Bank, I think it's still been quite okay.
What I like the headline is we fell 1% this week, and that was the biggest in 3 months. That shows the kind of momentum we are in the market, right? Yeah. 1% fall in a week and we got scared. So, I mean, that's the market is. I mean, you've seen such a big rally in the last so many weeks now that 1% fall leads to a biggest in three months, so to speak. So, yeah, but again, as Anuj pointed out, the biggest culprit was HDFC Bank. I spoke about Hrithik would dance, and the first H's also has started to fall. So yeah. I don't know what's going to happen with the Hrithik Bank. So
has the party ended and Hrithik has left the party?
So it was really bad for that gang to start on a wrong footing. So let's see what happens.
But X of that, it's been quite okay. I mean,
Infosys TCS was also okay. We'll see what ICICI Bank does. So let's see. But at least the first H was itself.
And of course, the Reliance would come out.
Yeah,
Reliance would come out. A P there, PSUs. Because that is dancing.
And Midcaps. There's absolutely nothing, stopping the Midcap rally. I mean, even yesterday also from intraday there was sharp recovery. Today, I mean, the Midcaps.
But again, in the Midcap, Anuj, it's all the PSUs. That's why there's a lot of momentum in the broader market, so to speak. Even in the broader market, it's the PSU Midcaps which are doing so well.
Actually, today I counted some 7 railway stocks which are up 10% and more.
Absolutely.
And some 8, 9 other PSU stocks, not banks. Banks is another complete list, which were up 15%, 20%. So absolutely.
So will come. All the data will come.
Exactly. But just one last point. I think what's happening right now is that there's just too much domestic money. I think in the near term, you just can't counter the money. I know Sonia has done some work on Midcap, so I won't sort of preempt that. But in the near term, clearly all of that is being negated by the kind of money, domestic money, which is chasing Midcap.
Absolutely. But I think the verdict is not out on whether this is a reversal in the trend, right? I mean, it's overall still been a bullish trend for the market, just that this week has been slightly tricky.
I'll just take 1 minute and I'll start with, because it's not just local, right? It's global as well. That first day when the market fell here, I was very surprised to see that on that same day, FIs had sold $5 billion in one single day, X of India. So including India, that day, which is Wednesday, when the market fell, out of Asia, out of 4 markets, FIs sold some $6.5 billion or so. So that's large. But I'll just quickly run you through a few points. So I'm calling this an everything rally, right? I mean, everything went up. And this week we saw a little bit of pullback of that everything rally. So the global, right? The top down. Slightly hawkish stars are starting to align once again. We're not used to that, right? The momentum has been that rate cuts are coming. Rate cuts are just around the corner. There's been some pullback to those expectations. So first you had those comments from Fed's Christopher Waller, who basically said methodically and rate cuts will come in quote unquote methodically and carefully. That's one. US consumer demand absolutely strong, raging. Jobless claims in the US lowest in 15 months. Job market is still strong. The inflation numbers in UK accelerated month on month after almost a year of falling. So that's another data point. ECB officials are now all singing the tune that we'll only see the first cut sometime later after the summer. And as a result of which, the pricing that rates are going to go down across markets, large markets, all of that is being pushed back. And what is that doing? It's pushing up yields. So the 10-year, for example, is about 4%. The 2-year in the US, which is the most closely aligned to interest rates, that's now almost about 4.5% or so. Here in India, as you guys have been discussing, I mean, it's been a dramatic week. And the simple question, and it's a question rather than an answer, is in the morning we were saying that we'll get a pullback rally. We got a pullback rally. For the NIFT, the only thing is that on Friday, that is today, we didn't build after the opening gains, right? I mean, that it fizzled out after that. Nifty Bank ended absolutely flat. So, you know, the way to maybe answer the question whether this is going to fizzle out or it's going to go on is to look at some levels. And on the Nifty, I think that level is it's a simple 38% retracement of the two-day fall, which is about 50% retracement, which is about 21,700. We didn't make 21,700 today. We fell 30 points short of it. And on the Nifty Bank, it is 46,530 or so, which is the 38% retracement of that two-day fall. So I think we'll find the answer to that. But I guess, you know, rally, crazy moves, 500-point rally, 600-point fall, and then a 150-point rally today.
Oh, absolutely. And let's see, I mean, if the markets indeed try to take some kind of support here, as Prashant mentioned. But let's ask that question to our guest, Andrew Holland. What did you make of this this week? Manic move, especially in the largest stock here back home, HDFC Bank. What's your view now?
So I think in the context of what Prashant just said, all those kind of positives as we came into the year become kind of more headwinds at the moment. But, you know, I know you talked about and used the word dramatic, but at the end of the day, we're probably just where we are, you know, levels of 4 or 5 days ago. I mean, we're down 0.5% for the month. It's not really so dramatic that it's changed my views on being more constructive going forward. But I think there's a few crucial things here. I think, you know, what happened, Anuj, is that we all got, you know, kind of very positive on the IT results. And we felt that if, you know, if HDFC Bank could deliver, then the whole banking sector would move up as well. And that would take us to, again, to new highs. And that hasn't happened. So I think all the focus is now over the weekend at Kotak and ICICI in terms of what their results are. If they're good and that there's no kind of, you know, kind of follow through from what happened with HDFC, then, you know, we could see that the banking sector at least kind of consolidate, if not move higher from here. But if that disappoints, if those companies disappoint, then I think we could test lows again.
Okay, well, since we're talking about the biggest stock, which was HDFC Bank, right? It came as a bit of a shocker, the kind of, you know, earnings that HDFC Bank put out and all the volatility in the stock. But Nigel has done some work for us on that. Nigel, over to you.
Well, let me hop across to the wall and, you know, explain this to you all. The stock of the week clearly was HDFC Bank. That big boy was an underperformer. It went down close to around 10% in the week itself, and it's just 1% away from its 52-week low. Now, what was the street concerned about? Deposit mobilization. That's the worry. Loan growth was fine at close to around 5% on a quarter-quarter basis. The problem is deposit growth was only around 2%. And that's what got the street a little bit worried out there. Now, the NIMs that they came in with were around 3.4% on a sequential basis, which was par for the course, right? The problem is that the LCR has come down from around 120% all the way to around 110% on. So basically, they've deployed the excess liquidity to make up for you know, the lack of deposits out there. And that's how they've managed to maintain their NIMs. The street is fearing that if deposit mobilization doesn't pick up, that's what could put that margin number as well at risk. So that's a big concern out there. Even in terms of branch addition, well, it's been far from good. You know, in this year so far, it's been much lower in comparison to last year. Though in Q4 as well as the first quarter of next year, they are guiding for nearly around 500 branches open out. You'll see that deposits will pick up. No, that will flow with a lag effect. So deposit mobilization from this as well will take some bit of time. What do you track from here on then? Uptick in retail deposit mobilization, that's going to be very, very important. Obviously, it'll have its impact on NIMs as well. And they're in a bit of a conundrum. Growth versus NIMs. I was, you know, talking to one sell-side analyst, and he was suggesting that maybe they don't grow in mid-teens. Maybe they'll grow in low teens, but focus on NIMs, you know, in the near term, and focus on replacing the high-cost liabilities of HDFC Limited that they have taken on their books. So maybe that is one view out there. So how does the stock price, you know, shape up as of now? It ended close to around 1,475 out here. The subsidies, they account for close to around 230, 250 rupees per share. So the core business is valued at around 1,250. And the EPS that the street is working with for this year, you know, it was at around 102. It's been scaled back to around 97 odd. Say even if they do 95, it's still trading at sub 13 times on an EPS basis. The problem is that there's a huge institution holding out there, and there is some fund selling that's evident on the screen. But is the downside limited from here? Well, time will tell on that one. Andrew, I just wanted you to come in on this one. HDFC, you know, you just gave us a brief idea out there. But what do you think? Do you think downside is limited on HDFC Bank at these prices, at this kind of earnings growth, and give and take everything?
So I think there's a couple of points here. Is what is, are they going to chase higher deposits and then therefore pay higher rates, and that's kind of a race to the bottom in terms of NIMs for everybody. So that's one question mark. Two is that we're going to have to wait a whole quarter to get this answer. So there's no real catalyst, for the share price in the very short term. And I think for foreign investors, this has been the bellwether of India in terms of growth, in terms of stability, in terms of the economy and the banking sector. So that's why you saw so much selling by FIIs or FBIs in the past few days. So until that narrative changes, or that the kind of, as you kind of pointed out, the NIM start to kind of improve, no one's going to take that bet anymore. That things are going to be okay in the very short term. So I think one more quarter will have to wait.
Okay, well, you know what, the big talking point has been the PSU space. In fact, I remember Nimesh had done a link some time back on the CPSE ETF. I mean, that index itself has doubled, and so many of stocks have given huge returns. But Nimesh, how are things looking now?
Well, Anuj, I just want to put a piece on the PSUs, right? It's been the story of 23 and the momentum continues. But let me just go to the wall and explain what the PSUs have done in the calendar year 2023. Just look at the kind of performance, the index has put in. The PSE index has rallied 81% in calendar year 2023. And they've added nearly 22 lakh crores in terms of market cap. The entire PSU basket has added nearly 22 lakh crores in market cap only in the last 1 year. If you look at the big gainers, the 1/3 of the PSU basket, which is 33 companies, have rallied between 100 to 300%. That's the kind of move we've seen in the PSU baskets in the last 1 year itself. Now, I'll just break into the different sectors now. The first sector I'm picking up is railways. Nobody knows where the train is going to stop. But just look at the rally and the kind of valuations now. I just want to put a word on the valuations. IRCTC, it's trading at 55 times on the current year valuations. Ircon, which has been the big mover, that's now trading at close to 18 times. RVNL close to 32 times, and Railtel is now trading at 35 times. I don't have the 5-year average for these companies, but this is the kind of valuation you're giving for the railway PSUs now. Next is look at the capital goods space. BHEL, that stock is, after rallying 155%, is now trading at close to 50 times. We don't have an average for that as well. HAL is now trading at close to 31 times versus the 10-year average of just 10 times. RITES is trading at 20 times versus the average of 12 times. And BEL is now trading at close to 34 times versus the 5-year average of 16 times. So that's the capital good basket, how they are trading at after the big rally in those stocks. The third is the power stocks. Look at the power stocks as well. NTPC, NHPC, SJVN and Power Grid. All are now trading in double digits multiple for current year valuations versus the 5-year average of all were trading they were trading in single digits. Now all are into double digits. SJVN is now trading at 22 times on current year price to earnings. Now look at the finances of the PSUs. IRFC, the biggest mover of 2023, that stock is now trading at 4.2 times price to book on current valuations. I don't think many of even private banks are not quoting that sort of valuations. REC, PSE are almost at 2 times now, which historically they've been trading at just half time in the past. So it's been a big move in terms of the power PSUs as well. Now look at the banking. This is an interesting chart. The PSU banks, despite the rally, look at the valuations now. SBI trading at 1.4 times, the historics around 1.4 times. So it's not trading at exorbitant valuations. Bank of Baroda, Canara Bank, all trading close to one time price to book. And historically, they've been close to one time or half time price to book. So in terms of valuation, the PSU banks are still not very, very expensive even after the rally. And same is the case with the OMCs as well. Look at the OMC stocks. They all have rallied and the momentum just continues. But even in terms of valuation, HPCL is now trading at close to 8 times. Historically, it's been trading at 4.5 times. BPCL, after the rally, is now still trading at 8.7 times, whereas historic has been around 10 times. Same is the case with IOC as well. The only outliner in that OMC basket is Chennai Petro. That is now trading at close to 8 times on current year valuations versus the historical average of around 2 times. So, again, as I said, the entire basket has done really well. The PSC stocks have added nearly 22 lakh crores in market cap, but keep an eye on the valuations. Some of the stocks are now trading expensive than even the private company stocks.
All right, Nimesh, thanks a lot for that. Andrew, you want to comment on that? The moves that we've seen in the PSU names. And for an investor, do you reckon that there could be some more upside despite the kind of valuation, despite the valuations being expensive?
Yeah, well, I mean, if you've not caught for the railway stocks, if you haven't caught the train early, then you're probably catching it quite late given those valuations. So I think, when I look at even at the PSU banks, usually when they get to, one time book plus, then, it's usually time that you'll see some kind of news coming out, which will bring them back to more normal levels. So I don't think I'd be chasing some of these kind of PSU stocks at the moment. I think there's many themes below the Nifty which will continue to play out, but I don't think I'd want to kind of chase some of these at this point. I think I'd wait I think these will be one of the first to, if you do get a sharp, kind of pull back in the markets, these are the stocks which will be hurt quite badly.
All right, you don't want to chase the PSU rally. Fair point, and perhaps it is prudent to be cautious at this point in time, even in the mid-cap end of trade. We'll talk about that on the other side of the break. Don't go anywhere. We'll be back in just a bit. Welcome back to Editor's Roundtable on CNBC-TV18. We are in conversation with Andrew Holland, and we are talking about how the valuations in the mid-cap end of trade have become expensive. Let's just put some data on board. Why is it time now to get cautious in the mid-cap space? If you compare it to the long-period average, Motilal Oswal released a very good report about how the valuations in the mid and small cap space are expensive, not just compared to Nifty, but compared to the long period average as well. If you look at it now, Nifty is trading at a 12-month forward PE of 19.6 times, largely near its long period average of 20 times. But look at mid-caps. Mid-caps are trading at a 12-month forward PE of 27 times, which is a 40% premium to its long period average. And small caps are now trading at a 12-month forward PE of 21 times, which is at a 7% premium to its long period average. Not just that, there seems to be too much leverage in the system as well. The margins are trading at a record high. The data is coming up for you on your screen. The margin trading facility book has been trading at a record high. So there is a lot of leverage in the system, and that could, lead to some amount of caution in the system going forward. Andrew, how do you approach mid caps now? Some of these non-index large caps have started to correct. If you have them in your portfolio, do you start to get a bit cautious, or is it still time to accumulate on a dip?
No, I think you have to choose. Obviously, these mid-cap and small-cap stocks. In terms of how you see the whole sector playing out within your kind of own portfolio. But what I would say is that below the Nifty, there's certain themes going on. I've talked about with this before, Sonia, in terms of, like they say, the beverage industry. We know it's got a long runway to go in terms of premiumization. So these are the kind of stocks you want to be buying if there's any dips. And I think we're just at the start of a very, very strong and broad kind of upturn for the beverage industry, both alcoholic and non-alcoholic. You can take the electronic manufacturing sector as being another sector, hotels, airlines. All of these will continue to play out. So yes, there will be dips. There will be pullbacks when markets fall. But these, if you've identified your stocks you like within that sector, then those are the ones you should continue to buy.
Andrew, what's your view on the IT names? It was a mixed bag, so to speak. Oracle rallied 28-30% after the numbers, while the others like L&T Maintenance were weak. How would you approach the IT names, and would you be a buyer at these levels?
No, I would. I think it's a very simple story. Interest rates are coming down in the US. That's going to give a tailwind for technology there, which will be obviously a great tailwind for IT here. So, you've got to look a year out and say that we're probably towards the bottom of the problem for IT companies in India, and therefore, going forward, towards the second half of the year, things will start to improve. And that's where you're going to get the kind of big valuation uptick for these stocks over the next six to 9 months.
Okay, all right, Andrew, thanks a lot for joining us. And with that, it's curtains down on this edition of Editor's Roundtable. You'll be seeing some of us tomorrow as well, because there's a trading session happening tomorrow. So I can't say happy weekend just yet. But thanks a lot for watching. Have a good one.